Part 1. Introduction. Game on. December 11th, 2024 marked a pivotal moment in American sports history at the NFL owners' meeting in Dallas, Texas. The NFL, long considered an impenetrable fortress, finally unbolted its gates by officially approving private equity investment. The media focused heavily on the names of the investment firms planting their first flags with the Buffalo Bills and Miami Dolphins. However, we must look beyond the immediate phenomenon to the underlying structure. Few realize that these deals are not merely investments, but the prelude to a massive civil war surrounding the Wall Street giant, KKR. To illustrate this situation, let's use a medieval kingdom analogy. Blue Owl, a powerful general who declared independence from the kingdom of KKR, has been aggressively conquering the neighboring territory of the NBA. Feeling threatened, the kingdom, rather than stepping in directly, has deployed a new mercenary commander backed by its own capital, Arctos partners, effectively declaring all-out war. Now that the final territory the NFL has opened up, this conflict is reaching its climax. In this session, we will examine how sports are being redefined as an asset class and who will emerge victorious in this battle between Arctos partners, which dominates the U.S. Big Four sports market, and Blue Owl Capital, formerly Dial Capital. Part 2. The Mechanics. The Key of Capital Opening Closed Doors. Section 1. The Unlocking of the NFL and the Path of Capital Infiltration. The first question to address is, why now? Among the big four U.S. sports leagues, the NFL, NBA, MLB, and NHL, the NFL was the last and most conservative to open its doors to private equity. While other leagues were already receiving capital infusions, the NFL stuck to its league of their own mentality. However, with the approval of the Buffalo Bills and Miami Dolphins deals in December 2024, this defensive line has collapsed. The mechanism to focus on here is the unique controlled openness system designed by the NFL Secretariat. The NFL does not accept just any fund. They created a pre-verified approved investors list, restricting participation to only those on this list. This list includes consortiums involving Arctos Partners, Ares Management, Sixth Street, Blackstone, and Carlyle. What does this structure signify? It is a declaration by the league office that they will accept the money, but will not allow the investors to act as owners. The NFL has strictly limited the stake a single fund can hold to a maximum of 10%. This is a minority stake that makes acquiring management rights or even exercising meaningful voting rights impossible. Nevertheless, investment firms lined up. Ares Management valued the Miami Dolphins at $8.1 billion and acquired a 10% stake, while Arctos Partners valued the Buffalo Bills at $5.8 billion, also acquiring 10%. Here we discover the first structural contradiction. Why did global PE firms bet billions on minority stakes without management rights in illiquid, private sports teams? It is at this very point that the differing calculations of Arctos Partners and Blue Owl and the shadow of KKR are revealed. Section 2. Arctos Partners. The exclusive status of the approved. Arctos Partners is the greatest beneficiary of this NFL market opening and the partner most preferred by the league office. By closing the Buffalo Bills deal in December 2024, Arctos became the protagonist of the first official PE deal in NFL history. With this, Arctos achieved an unprecedented grand slam by entering the NFL after already securing positions in the NBA, MLB, and NHL. The strategic mechanism of Arctos is clear. Rather than negotiating with individual teams, they communicate directly with the league office and adopt a model student strategy, moving within a regulatory sandbox. This strategy is even more evident in their portfolio construction. They prefer investing in holding companies that own multiple teams rather than direct single-team investments. For example, Fenway Sports Group, or FSG, which owns the Boston Red Sox, Pittsburgh Penguins, and Liverpool FC. Harris Blitzer Sports and Entertainment, or HBSE, which owns the Philadelphia 76ers and New Jersey Devils. And Smith Entertainment Group, or SEG, which owns the Utah Jazz and Utah Hockey Club. This holding company investment method offers investors a diversification effect similar to an ETF. But more importantly, this is a market dominance tactic executed by Arctos with KKR's capital on its back. KKR avoids the risk of friction with the league office by staying in the background, instead sweeping up the portfolio safely and broadly through its proxy, Arctos, which possesses sports expertise and networks. Conversely, there is an entity moving outside this approved list, or in a completely different manner even if listed. That is Blue Owl. We are referring to the Blue Owl Capital born from the merger of Owl Rock Capital, founded by KKR alumni, and Dial Capital. Section 3. Blue Owl, formerly Dial Home Court. The player concentrating on the NBA. If Arctos utilized an all-encompassing carpet bombing strategy to increase market share, Blue Owl is like a sniper aiming precisely at a target, and their scope is primarily trained on the NBA. Blue Owl's Dial Home Court Fund does not expand in an octopus-like fashion like Arctos. Instead, they have constructed a portfolio by selecting teams with the highest growth potential within a single league, the NBA. Representative examples include the Phoenix Suns, Sacramento Kings, and Atlanta Hawks. Blue Owl has always been present in major deals, such as the acquisition of Glenn Taylor's stake in the Minnesota Timberwolves or investments during Michael Jordan's ownership of the Charlotte Hornets. Here, the wild nature of Blue Owl, led by a KKR alumnus, becomes apparent. They are not passive investors simply waiting for league office approval. They maintain stakes even during chaotic periods of ownership change or bet boldly when a rise in team value is certain. If Arctos is an agent model valuing stability in relationships, Blue Owl is a hunter model valuing returns and selective investment. We can read the current structure of the sports finance market at the point where these two models clash head-on or strangely coexist. Part 3. The precedents, the battle between ETFs and active funds. Section 1. Structural differences in portfolio construction, ETF versus stock picker. To understand the depth of this internal conflict, let us liken the investment styles of these two houses to financial products. Arctos is the S&P 500 ETF of the sports market. Arctos has popularized the holding company investment method to hedge against the performance risk of specific teams. For instance, rather than investing directly in the Boston Red Sox, Arctos purchased a stake in their parent company, Fenway Sports Group, or FSG, which controls the Red Sox, Liverpool FC, and the Pittsburgh Penguins. Similarly, they invested in HBSE, owners of the Philadelphia 76ers and New Jersey Devils, and SEG, owners of the Utah Jazz and Utah Hockey Club. This structure offers investors three distinct advantages. First, the diversification effect. A single investment provides simultaneous exposure to multiple leagues such as MLB, NHL, EPL, and NBA. Second, risk dilution. Even if a specific team ruins its season, it can be offset by other teams or sports within the portfolio. Third, platform value. By securing equity in a sports empire rather than an individual team, investors share in derivative values beyond simple ticket revenue, such as real estate development and media rights. In contrast, Blue Owl is an active fund seeking high yields. They do not hide behind the umbrella of a holding company, but bet directly on the growth potential of individual teams. The NBA is the league with the youngest fandom and greatest scalability globally. Blue Owl, believing in this NBA premium, directly acquired stakes in individual teams like the Charlotte Hornets and Minnesota Timberwolves. This carries higher risk, but the upside potential for returns is significantly higher when those teams are sold or their value skyrockets. Section 2. The front lines, the encounter in Sacramento. There is a front line in the Civil War where these two strategies have clashed and overlapped. It is the Sacramento Kings. This team is a rare case where both Arctos partners and Blue Owl have executed investments. From Arctos' perspective, the Kings are a stable asset with good recent performance and real estate development potential through the Golden One Center. It fits well to round out their portfolio. From Blue Owl's perspective, the Kings are an NBA growth stock located in California's capital, closely tied to the tech scene. The fact that these two rivals sit under one roof signifies that sports teams are no longer mere toys for tycoons, but are being sliced and traded as strictly calculated financial assets. Imagine a scene where two factions carrying KKR DNA hold a shareholders meeting within a single team, albeit with minority stakes. This is a symbolic event showing how deeply capital has penetrated sports. Section 3. The future of NFL deals seen through precedents. Why Arctos? Returning to the NFL deal, it becomes clear why Arctos, not Blue Owl, was the protagonist of the first Buffalo Bills deal. The NFL is conservative. They wanted a systemic partner verified across multiple leagues who knows how to manage risk through holding company investments, rather than an aggressive hunter picking off specific teams. It is no coincidence that Arctos achieved the Grand Slam by winning the NFL's first official PE deal in December 2024. This is a victory for the trust capital strategy designed by KKR and executed by Arctos. Conversely, Blue Owl has either not yet made the NFL's approved list or is strategically concentrating on the NBA. However, the market knows that the moment the NFL truly throws the gates wide open, the first predator to jump in will be Blue Owl. Part 4. The incentives, why they risk civil war. Section 1. KKR's big picture. Ecosystem dominance over direct control. We must ask a fundamental question here. Why does the king of Wall Street, KKR, not buy teams directly, but instead attack the market indirectly via a proxy named Arctos? And why is Blue Owl, led by KKR alumni, walking an independent path competing with its origins? The answer lies in the structural thirst faced by the private equity industry. For KKR, sports teams are attractive but tricky assets. First is reputational risk. Fandoms are irrational. If a team owned by KKR goes on a losing streak or raises ticket prices, the criticism is directed straight to KKR headquarters. This could negatively impact their core business of managing pension funds. Second is the uncertainty of exit. Teams are difficult to buy and sell. This does not align with the physiology of PE funds that must sell illiquid assets within a fund's maturity period. Therefore, KKR selected Arctos Partners as a buffer zone. Arctos is ostensibly an independent fund, but has received capital and networks from KKR. KKR has designed an asymmetric profit structure where they enjoy the growth of the sports market through Arctos while avoiding criticism for management interference or poor performance. This is the hidden incentive that allowed Arctos to achieve a Grand Slam without friction with league offices. Section 2. Blue Owl's ambition, beyond fees to permanent capital. On the other hand, Blue Owl's incentives are different. They are hunters. Blue Owl's predecessor, Dial Capital, was famous for buying stakes in other PE houses. In other words, they were a PE for PES. Why would they buy direct equity in NBA teams? They are aiming to change the character of their assets. Sports teams are cash flow assets where tickets sell and broadcasting fees come in even during recessions. This is much more stable than high volatility buyout deals. By incorporating these sports assets, Blue Owl intends to evolve their fund from a simple private equity fund into something closer to permanent capital, like an insurance company or pension fund. Assets backed by stable cash flows receive higher multiples in the stock market. Blue Owl is a publicly traded alternative investment manager. To boost their stock price, an NBA portfolio with low volatility and high public recognition acts as an essential incentive. Section 3. The NFL's incentive. Priming the pump for valuation maximization. Then why did the NFL, the dominant power, unlock the gates now? While they ostensibly claim it is to secure liquidity for owners, the real reason is to break through the valuation ceiling. NFL team prices have already exceeded the level individuals can afford. The Washington Commanders sold for $6 billion. There are only a handful of billionaires on Earth who can mobilize $8 trillion, one in cash, to buy a team as a hobby. If potential buyers decrease, prices stagnate. This is the scenario NFL owners fear most. The entry of PE creates new effective demand to support team values. Even if PE firms buy only a 10% stake, that transaction price becomes the benchmark price for the entire team. For example, if Ares bought 10% of the Miami Dolphins at an $8.1 billion valuation, the value of the remaining 90% held by the owner is also reevaluated based on that $8.1 billion benchmark. In other words, PE investment acts as a lever to forcibly elevate the valuation of the entire market. Ultimately, this deal is the result of a triangular alliance where interests align perfectly. Arctos safely dominates the entire market. Blue Owl increases its corporate value with high-yield assets, and the NFL prevents a price crash and inflates team values. However, the peace of this alliance will not last long. The time is approaching when KKR's proxy and KKR's estranged ace will meet on a single log bridge. Section 4, Endgame. Who holds the key to exit? The ultimate victory or defeat in this massive civil war will depend on who exits more intelligently. Private equity firms cannot hold equity forever. Typically, they must sell their stakes within 5 to 7 years to realize profits. However, a liquidity trap arises here. Who will be the next batter to take over the stakes acquired by Arctos or Blue Owl? Team valuations have already skyrocketed beyond the reach of individual high-net-worth individuals. Therefore, only two viable options remain. First is the sale to sovereign wealth funds. Oil money, such as Saudi Arabia's PIF or the Qatar Investment Authority, represents the most likely candidates to absorb these stakes. The NBA and NHL have already partially permitted investment from sovereign wealth funds. The fact that Arctos has diversified its portfolio across the board may be a preliminary move to offload these assets in package deals to such massive capital pools in the future. Second is the IPO of team holding companies. This is likely the grandest picture drawn by KKR and Arctos. Holding companies invested in by Arctos, such as FSG or HBSE, have already reached the scale of major conglomerates. If these entities were to list individually on the NASDAQ, an era would open where general retail investors could own shares of the New York Yankees or Boston Red Sox via the stock market. If this scenario materializes, Arctos Partners would stand to generate astronomical returns as a pre-IPO investor who secured stakes prior to listing. Conversely, Blue Owl will likely modify its strategy to leverage the stock price volatility of listed sports corporations or to maximize dividend yields. Ultimately, this war is not merely a game of territorial expansion, but a speed race to determine who can first securitize sports assets and offload them to the public. Part 5. Conclusion. Fans are gone, only customers and shareholders remain. Today we have examined how two forces branching from the massive root of KKR, Arctos, and Blue Owl Capital are targeting the U.S. Big Four sports market. The summary of this phenomenon is as follows. The era has arrived where we must check changes in equity structure before checking game results in sports news. The revenue from a single beer drunk by a fan at the stadium or a single jersey purchased no longer flows into the pocket of a local team owner, but into the dividend yield cell of an Excel spreadsheet designed by Wall Street fund managers. What we are witnessing is not innovation by the Buffalo Bills or the Phoenix Suns. We are witnessing the most advanced process of structural subsumption in capitalism, where even the most primal and passionate entertainment is incorporated as a subcategory of financial capital. This is the cold underside of the sports we love.